Apple is up 9.7% in January. So if your expectation is like, let's extrapolate that and we'll be up 120% on the year, I think you'll probably be disappointed. So, yes, absolutely.
Put it into context, too, though. It's up, what did you say, 9%?
Almost 10% this month.
After 80-something% last year, right? So it's on top of what has already been a parabolic move.
Yeah, the stock is the highest in the room. It's insane. But look, there's weakness elsewhere. Not everything is going up. The XLE, the energy sector, lost 5% of its market cap in a week, literally since Monday. Biotech down 4%. Small caps down 2%. That's this week. So it's not as though everything is just being rewarded. Throw your money at whatever you want. That's not the environment. The other thing is all those 1999 comparisons. I don't want to embarrass anyone, but a really quick Google search and you will find some of the same people making some of the same statements in 2013. The unicorn cover for Fortune, I think that was 2015. So, like, if that was your cue, like, oh, such and such famous billionaire who's made a lot of money is making a 1999 comparison. Look how smart I am. I'm going to get out. That has not served you well. Let me point to something more constructive. Steven Suttmeyer is the chief technician at Bank of America Merrill Lynch, out with a really important note this morning talking about this pattern that's been recurring since the bottom in 2009, which are these 2-year consolidation periods leading to further new highs. We've just come out of a 2-year consolidation period in October. We finally made a new high after 2 years of going nowhere in the Dow, the S&P, NASDAQ's an exception, and the S&P and the small caps. So we've had these periods where markets have done nothing, and then you have this spurt where they break out. Those breakouts have lasted an average of 30 months. So it's a little bit early to say that this will be the same thing. But if you actually look at what's happened in the 2011 instance and in the 2015-16 instance, coming out of those 2-year consolidation periods, that would put the S&P, if we did something similar, up at 3,700, 3,800. So okay. I think it's like early to be screaming 1999.
So Kate Moore, Bank of America today talks about the irrational bull phase continues, excuse me, in Q1, pushed by liquidity from the Fed. All goes back to the Fed.
Look, we think liquidity is super important for the move in beta, like in general, and that's been a core part of our market commentary. What I will say is there's a lot more lining up to support equities, I think, than the bears would like you to talk about. First of all, not only do you have the liquidity, but you have supportive policy around the whole world. This is not just like monetary policy, but we're also seeing bits of fiscal policy. You have a bunch of green shoots, too, in key markets. Like I say this in China. I also feel like we've seen a couple green shoots in Europe, some slightly better than expected data. I think companies are giving some decent guidance, especially the ones that were really cyclically oriented, that fourth quarter was probably the bottom in terms of their overall cycle. So you're getting lots of confirmation. Business confidence has picked up. I just don't see that we are overly exuberant right now in the market because every single salesperson who calls me says the same thing. Are you worried about the market? We're all worried about the market. Are you protecting yourself? Do you want to hedge?
Okay, well, speaking of the sell side, you don't take any pause whatsoever that the stocks go up and the price targets go up and up and up and up and up. Alphabet today, the price target goes to 1769 from 1546.
Yeah.
Apple has a new high on the street. Dan Ives over at Wedbush, that goes to 400 from 350. Facebook's target goes up. Tony Dwyer says today, throughout the week, we got further evidence that supports our view for taking a more neutral position until the market works off some excess. He's talking about tech needing to reset in order to have a more sustainable move higher.
Everyone would like a pause, particularly those people that have not been participating in this last strong run. I mean, everyone is saying, wouldn't it be great to have a 3, 5, 7% pullback? Because everyone wants to re-up their high-quality, long-term
but they won't do it. When we're down 7, those same people are going to be like, we're about to be down 20.
Running for the hills. Yeah. Absolutely. But every time
that is absolutely right.
Yeah.
Okay.
I mean,
I've been around a while.
They're not actually having that kind of discipline that they would suggest otherwise if they were. What I think is happening here is that you have people who are really worried about the sustainability of economic growth in against the backdrop of politics and geopolitics. They're worried that every bit of headline is going to take risk off. But the more people get concerned and the more people put money into bond funds, the more I say, as long as we have stability in the economic data and the earnings story is better than 2019.
Is it better? Because right